Intel dropped their Q2 2025 earnings yesterday, and honestly, these numbers tell one of the most complex turnaround stories in tech right now. Revenue came in at $12.9 billion, which actually beat expectations and stayed roughly flat year over year. That sounds decent until you see the bottom line. A net loss of $2.9 billion, or $0.67 per share on a GAAP basis. Even the non-GAAP loss of 10 cents per share missed analyst expectations. The gross margin of 29.7% got hit by $800 million in write-downs, which shows just how much restructuring Intel is going through right now. But here's what's interesting. Despite the massive losses, they're guiding Q3 revenue to $12.6 to $13.6 billion, with a midpoint of $13.1 billion that's actually above analyst estimates. That tells me there's still underlying demand for Intel products, even as they're going through this painful transformation. The market reaction was pretty brutal initially, but I think investors are missing the bigger picture here. This isn't just about one quarter's numbers. This is about whether Intel can execute on what might be the most ambitious turnaround in semiconductor history. The new CEO, Lip-Bu Tan, who took over in March 2025, is basically saying no more blank checks and implementing the kind of discipline that Intel hasn't seen in years. When you've got a company with Intel's engineering talent and market position going through this level of restructuring, the result could be either spectacular success or complete disaster. There's not much middle ground here. Let's talk about the elephant in the room. Intel is cutting 15% of their workforce, which means about 75,000 employees by the end of 2025. That's not just belt tightening, that's a fundamental restructuring of how Intel operates. Tan is also pulling back from projects in Germany and Poland, slowing down the Ohio fab construction, and basically saying Intel needs to focus on what actually makes money. This is exactly the kind of decisive leadership Intel has needed for years. The previous management kept throwing money at problems without clear ROI, and Tan is putting an end to that. The goal is to reduce operating costs to $17 billion in 2025 and $16 billion in 2026, which would represent massive savings. What I find encouraging is Tan's background. He's not just another corporate suit. He actually understands semiconductor manufacturing and design from his time at Cadence Design Systems. When he talks about the 18A technology making steady progress on yield and performance targets, I believe him because he knows what he's looking at. The Foundry business, Intel Foundry Services, actually grew 3% year over year to $4.4 billion in Q2, which shows there's real customer interest in what Intel is building. Yeah, it's still unprofitable, but Foundry businesses take years to mature, and the growth trajectory is encouraging. Tan's approach seems to be fix the cost structure first, then invest aggressively in the technologies that will determine Intel's future. That's exactly the right sequence, even if it's painful in the short term. Here's where Intel's story gets really interesting from a competitive standpoint. Everyone knows NVIDIA dominates AI chips with over 90% market share in data center GPUs, but Intel isn't just rolling over. Their Gaudi AI accelerators are actually competitive with NVIDIA's H100 in certain workloads, and they're pushing hard on the open ecosystem angle versus NVIDIA's more closed approach. The real battleground, though, might be AI PCs, where Intel's Core Ultra processors are going head-to-head with AMD's offerings. Intel claims their chips are ahead in some AI benchmarks, which matters because AI PCs could be the next major upgrade cycle that gets consumers buying new computers again. What's smart about Intel's AI strategy is they're not trying to out-NVIDIA in the data center. Instead, they're focusing on bringing AI everywhere in edge computing, PCs, embedded systems. That's a much broader market where Intel's manufacturing capabilities and ecosystem relationships give them real advantages. The Xeon processors are already powering a lot of AI inference workloads, and if they can get the Gaudi chips to capture even 10% of the training market, that's still billions in revenue. The key is execution and time. Intel needs to prove that their 18A process technology can deliver chips that are competitive with TSMC's leading-edge nodes. If they can do that, their foundry business becomes viable, their own chips become more competitive, and suddenly they're back in the game across multiple fronts. Everything Intel is doing right now basically comes down to whether their 18A process technology works. This isn't just another incremental improvement. 18A combines RibbonFET transistors with PowerVia architecture, which could deliver major improvements in both performance and power efficiency. If it works, Intel suddenly has a manufacturing advantage again. If it doesn't, they're stuck buying advanced chips from TSMC like everyone else, which kills their foundry dreams and limits their competitiveness. The early signs are actually encouraging. Customer engagement is increasing, yield rates are improving, and they're hitting performance targets. But we've heard this before from Intel. They've been promising manufacturing leadership for years while TSMC pulled ahead. The difference now is Tan's leadership and the company's focus. They're not trying to do 10 things at once anymore. The 18A technology is the priority, and everything else is secondary. That's probably the right approach, but it's also incredibly risky. If 18A doesn't deliver, Intel's entire foundry strategy falls apart. On the flip side, if it works, Intel could capture external foundry customers while also having the best manufacturing technology for their own chips. The foundry market is huge. TSMC makes over $70 billion annually, so even capturing a meaningful portion of that market would transform Intel's financial profile. The timeline is critical, though. They need to prove 18A works and start ramping production while TSMC is between major technology nodes. The window is probably 12 to 18 months to show real progress. Intel's foundry strategy is probably the most underappreciated part of their turnaround story. Most people focus on their CPU business and AI chips, but the foundry business could be what determines Intel's long-term survival. Right now, only TSMC and Samsung can manufacture the most advanced chips at scale. If Intel can join that club with 18A, they immediately become critical infrastructure for the entire tech industry. The $4.4 billion in foundry revenue in Q2 represents just the beginning. Major tech companies are desperate for manufacturing alternatives to reduce their dependence on TSMC, especially given geopolitical tensions around Taiwan. Intel's foundry could become a strategic asset for U.S. national security, which means government support for their expansion. The challenge is convincing customers to trust Intel with their most critical chip designs. That trust takes years to build, and Intel burned some bridges when their manufacturing technology fell behind. But Tan's track record and the early 18A results are helping rebuild confidence. Apple probably isn't coming back anytime soon, but there are plenty of other customers who would love a viable alternative to TSMC. The economics are compelling too. Foundry businesses have higher margins than traditional product businesses once they reach scale. Instead of Intel having to design, manufacture, and market their own chips, they just focus on manufacturing excellence and let customers handle the rest. That's a simpler, more profitable business model if they can execute it. Looking at Intel's situation, this feels like one of those inflection point investments where the outcome is binary. Either it works spectacularly or it doesn't work at all. The next 12 to 18 months are critical. We need to see 18A technology proving itself with real customer wins, the cost reduction program showing results in the financials, and some market share progress against AMD and NVIDIA. If those things happen, Intel could be dramatically undervalued at current levels. But if 18A struggles, the foundry strategy stalls, and the cost cuts aren't enough to return to profitability, this could be a value trap. What gives me some confidence is the new leadership and the severity of the changes being made. Tan isn't making incremental adjustments. He's fundamentally restructuring how Intel operates. The workforce reduction is painful but necessary. The focus on 18A is the right strategic priority. The foundry business provides a legitimate path to growth and diversification. The AI positioning across multiple markets is smart. The question is execution and timing. Intel needs almost everything to go right over the next year to justify the current valuation and investor confidence. But when you look at the potential market opportunities, AI everywhere, foundry services, manufacturing leadership, the upside could be enormous if they pull it off. This is definitely not a safe, steady investment. It's a bet on one of the most important technology companies in the world successfully reinventing itself. The risk-reward profile is extreme in both directions, which is why the stock has been so volatile and why analyst opinions are all over the map. So if you found this analysis helpful and want more deep dives into major tech companies navigating complex transformations, make sure to hit that like button and subscribe to the channel. But remember, everything I've shared here is just my opinion and analysis. This is not financial advice. Intel is going through a major turnaround with significant execution risks, so always do your own research and never invest more than you can afford to lose. See you in the next one.